welcome to all of you, Shiksha 360. And today, basically, we will discuss chapter number 32, that is risk management and credit rating. Clear? Chapter number 32, that is risk management and credit rating, part 1. Clear? Part 1. This session, basically, we have to discuss in two parts, part 1 and part 2. Clear? So, let's start our discussion. So, what is the meaning of credit risk? Clear? Basically, we have already discussed different types of risk in chapter number 9 of BFM. Clear? So basically, let's discuss once again basically what is the meaning of credit risk. Clear? So the risk faced by the business of banking. Clear? The risk basically faced by the business of banking basically can be classified into three broad categories. Clear? The risk basically faced by the business of banking can be classified into three broad categories. First one is the operational risk. Second one is the market risk. Third one is the credit risk. Clear? Third one is the credit risk. So let's discuss one by one. Operational risk. Basically, what are operational risks? Basically, the examples of such risk basically are due to the losses due to the frauds, or losses basically due to the frauds, or disruption of business due to the natural calamities like floods, etc. Clear? So that are basically comes under the operational risk. Clear? All the things basically comes under the operational risk, like basically loss due to the fraud or disruption of business, basically due to the natural calamities like floods, etc. Clear? Next one is the market risk. Clear? Basically, market risk basically we will know that that basically resulting from the adverse market movements. Clear? The risk basically resulting from the adverse market movements of interest rates, exchange rates, etc. Clear? Basically, adverse market movement, market risk basically either due to the interest rate or due to the exchange rate. Clear? Due to the exchange rate. Next one is the credit risk. Clear? Basically, next one is the credit risk. Basically, when the credit risk basically can be defined, the credit risk basically can be defined as the unwillingness. Clear? The credit risk basically can be defined as the unwillingness or inability of a customer. Clear? As defined, can be defined as the unwillingness or ability of a customer or a counterparty. Clear? To meet his commitment relating to a financial transaction with the bank. Clear? Basically, inability, unwillingness, or the inability of a customer or a counterparty to meet its commitment. Clear? To meet his commitment relating to a financial transaction with the bank. Clear? Relating to a financial transaction with the bank. Here, basically we can say that LC, basically all of us basically we know that letter of credit is in a non-fund based. Clear? But in the case of default, clear? Basically, but in the case of default, it becomes fund based. So basically, credit risk, basically example, the LC opening bank in a bills and negotiation transaction under that LC. Clear? Basically, when the person who opens the LC, clear? Basically not paying the amount to the counterparty. Clear? So basically that is comes under the credit risk. Clear? That is basically comes under the credit risk. Clear? One of the type. For example, in a fund-based limit, the credit risk is the non-payment of principal and interest by the borrower as per the agreed of a repayment. Clear? Agreed terms of the repayment. And in the case of a non-fund-based limit, clear? And in the case of a non-fund-based limit, the credit risk arises. Clear? And in the case of a non-fund-based limit, the credit risk arises as the customer may not reimburse the bank fully in case of invocation of a guarantee or devolvement of an LC. Clear? In case of invocation of a guarantee or devolvement of an LC. Clear? Or devolvement of an LC. Clear? So basically, credit risk here basically we know that it occurs basically in both, in the fund based and in the non-fund based. Clear? In the fund based, basically when the credit risk basically is the non-payment of principal or interest by the borrower as per the agreed terms of the repayment. And in the case of a non-fund based limit, the credit risk arises. Clear? And in the case of a non-fund based limit, the credit risk basically arises as basically as the customer may not reimburse the bank fully in case of invocation of a guarantee or devolvement of an LC. Or development of an LC. Clear? So basically these are the different types of risk. Clear? These are the different types of risk. Hope it is clear to all of you. Now basically we'll move to the next point. What are the factors basically affecting the credit risk? Clear? What are the factors basically affecting the credit risk? Clear? So basically some factors are to be internal as well as external. Clear? So there are both the factors, internal as well as external. Clear? So what are the factors basically affecting the credit risk? Basically both are the factors. Clear? Internal as well as internal, basically both affect the credit risk. Clear? So let's discuss one by one. What are the external factors? Clear? First of all, basically we have to discuss here basically what are the external factors. So these factors affect the business of a customer. Clear? Basically external factor, basically these factors affect the business of a customer and reduce his capability. Clear? And reduce his capability to honor the terms of a financial transaction with the bank. Clear? And reduce his capability basically to honor the terms of financial transaction with the bank. Clear? To honor the terms of financial, to basically to honor the terms of financial transaction basically with the bank. Clear? So basically we can say that that is not under the control of the customer. So basically the main external factors affecting the overall quality of the credit portfolio of a bank are exchange rate. Clear? Of a bank. First one is, what is the first one? That is factor, that is exchange rate, interest rate fluctuations. I think all of you are aware that basically these factors basically we have already discussed under the market risk also. Clear? Under the market risk also. Clear? So the main external factors basically affecting the overall quality of the credit portfolio of a bank are exchange rate and interest rate fluctuations, government policies also, protectionist policies of other countries, political risk, etc. Clear? All are comes under the external factors. Clear? And I request to all of you, please remember, basically here, basically we will discuss 5 external factors: exchange rate, interest rate fluctuations, government policies, protectionist policies, political risk. Clear? Because in the examination, basically you will get question from that also. Clear? Like which of the following is not the external factor? Clear? So basically these factors look similar to what is mentioned under the market risk above. Clear? But whereas the market risk directly affect a bank, so the factors mentioned here basically affect the business of the customers, so thus impairing the quality of the credit portfolio. Clear? Generally basically market is basically directly affecting the bank, but here the factors mentioned obviously affects the business of the customers. Clear? Business of the customers. Clear? So if they affect the business of the customers also, so basically it comes under the credit risk. Clear? So thus impairing the quality of the credit portfolio. Clear? So thus impairing the quality of the credit portfolio. Clear? So these are the external factors. Clear? Here just you have to remember that basically what are the external factors here. Next one here comes out to basically internal factors. Clear? Next one basically comes out to be internal factors. So what are the internal factors? So basically these mainly relate to the overexposure. Clear? Like basically we can say that we have 100 crore or 1000 crore. Out of that basically we lend 950 crore to a single party and only 50 crore left for the other parties. Clear? That is overexposure or concentration of credit to a particular segment. Clear? Or we can say that either to a particular customer or to a particular segment. Like basically we can say that only in the retails, only in the basically we can say that MSME sector or agriculture sector. Clear? Like this way. So basically internal factors, basically these mainly relate to the overexposure of credit basically to a particular segment or geographical region, or excessive lending to the cyclical industries. Clear? Excessive lending to the cyclical industries. Cyclical industries basically we can say that like tourism. Clear? Basically in where in a particular season, clear, customers will go, and in the other season basically customer will not going. Clear? Cyclical industry, like basically we can say that ice cream factory is also one of the cyclical industries. Clear? Because in the summer there is more demand. Clear? Excessive lending to the cyclical industries, ignoring purpose of loan, faulty loan, and repayment structuring. Clear? And repayment structuring. Clear? Or deficiencies in the loan policies of the bank. Clear? Deficiencies in the loan policy of the bank, low quality of the credit appraisal and monitoring. Clear? Low quality of the credit appraisal and monitoring, and lack of an efficient recovery machinery. Clear? And lack of an efficient recovery machinery. Clear? So all these are the internal factors. Clear? So these mainly relate to the overexposure, that is concentration of credit to a particular segment or geographical region, excessive lending to the cyclical industries, and ignoring purpose of the loan, faulty loan and repayment structuring, deficiencies in the loan policy of the bank. Like basically we can say that basically we are not fulfilling the guidelines, basically we are just sanctioning the loans and not giving any view on that. Clear? After sanction of loan, clear? Basically whether money is used at the particular place or not. Clear? Whether there is any diversion of funds or not. Clear? Basically we are not looking towards that. Low quality of the credit appraisal and monitoring, and lack of an efficient recovery machinery. Clear? And lack of an efficient recovery machinery. Clear? So all these things basically comes under the internal factors. Clear? All these things basically comes under the internal factors. Now move to the next one here. What are the steps? Clear? What are the steps to be taken to mitigate the credit risk? Clear? Basically, what are the steps to be taken to mitigate, or we can say that to reduce the credit risk? Clear? To reduce the credit risk. Clear? So what are the steps to be taken here? So the major objective, clear? The major objective of the credit risk, clear? Here the major objective of the credit risk management is to limit the risk basically within acceptable limit. Clear? Is to limit the risk basically within acceptable level, and thus maximize the risk adjusted rate of return on the credit portfolio. Clear? Basically it means that basically we have to take the risk, but basically we have to manage our risk in that way so that basically our RAROC is a maximum. Risk adjusted, clear? Risk adjusted rate of return, clear? We can say that RAROC is a maximum. Clear? That is risk adjusted rate of return on the credit portfolio is to be maximum. Clear? Like basically we can say that if we are 1000 crore, so basically we can say that basically under the retail, basically we have to section 500 crore, under the agriculture 400 crore. Clear? Like this way. And under the retail further basically MSME we have different thing. For housing loan basically we have different, for vehicle loan basically we have different. Clear? Like this way. In this way basically we have to manage our portfolio. Clear? For the gold loan it is to be different. Clear? So basically we have to manage in this way. Clear? So that basically we are reducing our risk. Clear? So that basically we are reducing our risk. So basically following are the main steps basically taken by any bank in this direction. Clear? So basically what are the main steps here? First one is the at macro level. Clear? Basically we can say that at the overall level. The second one is basically at the micro level, basically for the particular account, basically we can say that. So let's discuss basically at the macro level. Clear? At the macro level. So the risks to the overall credit portfolio, clear? The risks basically to the overall credit portfolio of the bank are mitigated basically through frequent reviews of norms. Clear? Basically through frequent reviews of the norms and fixing internal limits. Clear? And fixing internal limits for aggregate commitments basically to the specific sectors of the industry. Clear? And fixing internal limits. Clear? And fixing internal limits for aggregate commitments. Clear? Basically and fixing internal limits for aggregate commitments basically to specific sectors of the industry or business, so that the exposures are evenly spread over various sectors and the likely loss is retained within tolerable limits. Clear? And the likely loss is retained within the tolerable limits. Clear? Like basically we can say that this one is like basically we have to divide it. Clear? Basically for this sector basically we have this much amount, for this sector basically we have this much amount. Clear? Further basically we have to divide it. Clear? Basically for that specific sector basically we have to limit this much amount. Clear? So that we cannot face any issue in the upcoming time. Clear? In the future. So banks are also periodically, clear? Banks are also periodically reviews the loan policies. Clear? Banks are also periodically basically reviews the loan policies basically relating to the exposure norms to a single and group of borrowers. Clear? Basically to a single or a group borrowers, as also the structure of discretionary powers vested with the various functionaries. Clear? Basically they are also changing. Like we can say that basically earlier basically branch had sanctions loans up to 10 lakh. Clear? Now basically they can reduce or enhance the limit. Clear? As per the policy. Many banks basically classify their credit portfolio. Clear? Many banks classify their credit portfolio basically based on some parameters of the quality. Clear? Basically many banks classify their credit portfolio basically based on the some parameters of the quality and periodically review this to avoid any rude shocks relating to the credit losses. Clear? And periodically basically review this to avoid any rude shocks to the credit losses. Clear? One thing more here, but presently this is not under the practice. Earlier, basically, RBI has made it mandatory to classify the portfolio basically by assigning the health codes to each account. Clear? Basically, presently, basically, we are not doing anything regarding that. Clear? Like health code to the each account. Clear? Basically, what is the quality of that account? Basically, according to that, basically, we have to assign one code. Clear? But presently, this is not under the practice. But this is not mandatory now. Normally, banks also formulate policies. Clear? Normally, banks also formulate policies relating to the rehabilitation, compromise. Clear? Relating to the rehabilitation, compromise, recovery, and write-off to get the best out of a worst case scenario. Clear? Sorry. Normally, banks also formulate policies basically relating to the rehabilitation, compromise, recovery, and write-off to get out the best, to get the best out of a worst case scenario. Clear? What is the rehabilitation? What is recovery? What is write-off? Basically, we have to discuss in detail under chapter number 33. Clear? Just common terms, I think all of you are aware regarding that. Clear? So basically, this is the control at the macro level. Clear? This is the control at the macro level. Now, next one is basically we have to discuss at the micro level. Clear? At the micro level. So basically, this pertains to policies. Clear? Basically, this pertains to policies of the bank regarding the appraisal standards. Clear? Basically, how we can appraise our loan. Clear? Basically, how we can check the quality of the loan. Sanctioning and delivering process, monitoring and review of individual proposals and categories. Clear? Sorry. Monitoring and review of individual proposals and categories of proposals, obtention of collateral security, etc. Clear? Obtention of collateral security, etc. Here also, credit rating. Clear? Credit rating and credit scoring. Clear? Credit scoring play an important role in this area. Clear? Credit rating, basically, these are the agencies. And credit scoring, basically, what is your score? Clear? What is your score? I think all of you have go through the chapter number 6 of retail. Already uploaded the video. Under that, basically, we have discussed in detail what is credit scoring. Very, very important chapter for the examination point of view also. Clear? Uploaded in the retail group. Clear? Just go through regarding the credit scoring. Very important. So for the dispersion or transfer of risk, clear? Basically, in the large account, basically, how we can reduce the risk. So basically, for the dispersion and the transfer of risk in the large value accounts, basically, bank can resort to consortium or multiple banking. Clear? Consortium or multiple banking, and use of derivatives like credit default swaps. Clear? And use of derivative. Clear? Basically, this is one of the derivative, that is credit default swap. Clear? Basically, which we have to discuss in our today's session. Clear? Under the consortium banking, basically, we have lead bank. So can anyone remember basically what is the meaning of syndication fee? As basically we have already discussed in the previous chapter. What is the meaning of syndication fee? Can anyone tell? It is also related to the consortium banking. What is the meaning of syndication fees? Please tell. So this is basically the how to reduce our credit risk basically at the macro level and at the micro level. Clear? Hope it is clear to all of you regarding both these things. Now move to the credit rating. Clear? Now move to the credit rating. Clear? So basically this is to be done by the credit rating agencies. So the level of credit risk, clear? The level of credit risk basically involved in each loan proposal depends upon the unique features of that proposal. Two similar projects, clear? Basically, if the projects are two similar projects, basically we can say that building, contract of a building, clear? Basically with the different promoters, like basically here A has to build a building, and on the other side B. Same project may be appraised by a bank as having different credit risk. Clear? Basically as having different credit risk. Clear? So basically two similar projects basically with the different promoters. Clear? Also have different credit risk. Similarly, two different projects. Clear? Basically if A can come into the bank basically with the two different projects. Clear? With the same promoter. Clear? With the same promoter may also be appraised by the bank as having two different credit risks. Clear? As having different credit risk. Clear? So basically there is not any compulsion that the risk is to be same. Clear? Risk is to be same. Either you are working in the same field or you are working in the different field. Clear? So there is not any such compulsion that the risk is to be the same. So basically, while appraising a credit proposal, clear, basically while appraising a credit proposal, the risk involved is also measured. Clear, basically while appraising a credit proposal, the risk involved is also measured and often quantified basically by way of a rating with the following objectives. Clear, first one is to decide about accepting, rejecting, or accepting with the modifications or special convenience. Clear, basically to decide basically about whether you are accepting a proposal or rejecting, or if you are accepting a proposal basically with some modifications. Clear. Second one is basically to determining the prices, that is the rate of interest to be charged. Clear. You know that basically if you are taking the CIBIL score, so basically it depends upon your score. Clear. Basically how much interest rate is to be charged from you. Clear. So it basically depends upon the score. Clear. Basically how much interest rate will be charged from you. Clear. Basically how much interest rate basically will be charged from you. Third one is basically to help in the micro evaluation. Clear. To help in the macro evaluation of the total credit portfolio, basically by classifying it on the ratings allotted to the individual accounts. Clear. Basically by classifying it on the ratings basically allotted to the individual accounts. Clear. Basically from the individual accounts, basically we are able to get the total credit portfolio classification. Clear. So basically this is used for assessing the provisioning requirements. Clear. Basically this is used for assessing the provisioning requirements. Clear. Basically like basically we can say that basically if there is a higher risk, so basically bank have to keep more amount. Clear. As per the loan. Clear. As per the loan. Clear. So basically this is used for assessing the provisioning requirements as also as a decision making tool by the management of the bank for reviewing the loan policy of the bank. Clear. Basically for reviewing the loan policy of the bank. Clear. So basically these are the main objectives. So next one is basically what are the internal and external. Clear. Basically sometimes there is an internal rating model and some there are at sometimes basically we will use external rating models. Clear. Basically most of the banks in India have set up their own credit rating models. Clear. Basically most of the banks in India have set up their own credit rating models. As till recent past, the rating agencies basically were not equipped well enough to provide the ratings. Clear. Because in the earlier times, basically the rating agencies are not capable basically to give the desired results. Clear. So basically banks have their internal credit rating models. Clear. Most of the banks in India basically have set up their credit rating models. As till recent past, the rating agencies basically were not equipped well enough to provide the rating so reliable as to banks depending on these credit decisions. Clear. So basically example of some few credit rating agencies like CARE, ICRA, CRISIL, SMIRA. Clear. So basically these are the four credit rating agencies. First one is the CARE, CARE. Second one is the ICRA, ICRA. Third one is the CRISIL. Fourth one is the SMIRA. Clear. Third one is the CRISIL. Fourth one is the SMIRA. Clear. So basically these are some of the credit rating agencies. Clear. Credit rating agencies. Credit rating agencies. Clear. And something basically this is different. Credit score is different. Clear. Not like basically to get the credit score basically we will use like Equifax, Experian. Clear. Basically we are using these tools. TransUnion, CIBIL. Clear. So here these are the credit rating agencies. Clear. This is the main difference. Clear. Here credit rating. Clear. These are the agencies. Credit score, basically from where basically we will get the 3-digit score of the portfolio of a particular person. So now what are the methodology of the credit rating? Clear. Basically what are the methodology of the credit rating? Clear. So based on its loan policies and the risk perceptions. Clear. Basically each bank has its own credit rating model. So common features in all the risk model is that a score is given. Clear. Common features basically in all the risk model is that a score is given basically for different perceived risks by allotting different weightages. Clear. By allotting different weightages. Like basically we have already discussed, like history, payment history. We can say that it is given 35%. Clear? Basically, how you have done the payment of your previous loans. Clear? Given 35% weightage. How many you have loan accounts? 20% weightage. Clear? Like this way. Clear? So common features in all the risk model is that a score is given for different perceived risks by allotting different weightages. Clear? A score is given basically for different perceived risk basically by allotting different weightages. So the sum of all these scores, clear, the sum of all these scores basically forms the basis. Clear? The sum of all these scores basically form the basis for deciding on a risk rating of a proposal. So normally the broad categories of risk areas which are scored are, first one is the promoters or management expects and the securities available. Clear? First one here basically the promoters or management expects and what are the securities available. Second one is the financial expects basically based on analysis of the financial statements. We can say that the balance sheets clear, all these things or the IT are clear. Financial expects basically based on the analysis of the financial statements. Third one is the business or project risk. Clear? Basically in which field basically they are going to invest the money. Clear? Basically they are going to do the business. Clear? Depending upon that also. Clear? Credit rating plays their role. Clear? Credit rating plays their role. Clear? So in view of the dynamic market scenario, clear, basically in view of the dynamic market scenario, there is need to review the ratings of a borrower at regular intervals, upgrade or downgrade or maintain it. Clear? So basically they have to continue a review. Clear? Basically either to upgrade the policies or to downgrade or to maintain it. Clear? Or to maintain it. Clear? Depend upon case to case. Clear? So in view of the dynamic market scenario, there is need to review the ratings of a borrower basically at regular intervals, upgrade or downgrade or maintain it. Clear? Or maintain it. Clear? So these are the methodology of the credit rating. So basically what are the use of credit derivatives? Clear? Basically initially basically we will discuss regarding the CDS. Clear? CDS. Clear? So basically this is one of the derivatives. Clear? To reduce the risk. So basically use of the credit derivatives basically for the risk management. Clear? Basically for the risk management. So here basically we will discuss first of all regarding the credit default swaps. Clear? Credit default swaps, and second one basically we have to CLN, credit linked notes, LINKAD. Clear? So first of all, credit default swaps basically use as a new hedging instrument. Clear? New hedging instrument, or basically we can say that basically how to reduce our risk. Clear? How to reduce our risk. Like we are purchasing a car, like basically we are purchasing a car. So basically how we can reduce our risk by taking the insurance. Clear? By taking the insurance. Or basically we are working in a factory. Clear? So basically there is also insurance, like all of you are basically working in the bank. So basically banks also provide your insurance also, medical facility also to all of you. Clear? So basically these are basically to mitigate the risk, we can say that. So basically how the credit default swaps plays their role here to reduce the risk. Clear? To reduce the risk. So let's discuss one example here. Clear? Let's discuss one example here. So basically this is a bond, or we can say that this is a corporate bond. Clear? Credit default swap, it is basically for the retail customers. Okay, so let's discuss. So this is a corporate bond. Clear? Here Rahul is here. The bond is of basically we can say that rupees 20,000, and the tenure of the bond is 10 years. Interest rate here is to be 8%. So what is the meaning of that? Basically this company, we can say that company is basically, we can say that this one is a company XYZ. It is a basically requires money of amount 20,000. Clear? Basically for the long tenure. Clear? So basically how they will get that money? Basically by issuing the bonds. Clear? By issuing the bonds. So here basically Rahul will buy the bond. Clear? Rahul will buy the bond. Rahul give the cash here and get the bond. Give the cash here and get the bond. Okay. So why Rahul will buy? Because they know that basically they are getting the principal at the end of 10 years along with the 8% interest rate. Clear? Along with the 8% interest rate. This interest basically you can also say that the coupon. Clear? In the case of bonds, you can say this as the coupon. Clear? As chapter number 12 and chapter number 17. Basically, we will not say at any place interest rate. Clear? Basically, we will say that the coupon. Clear? We will say that generally the coupon. Clear? So 8% coupon rate. So basically here, Rahul will sometimes feel that after 10 years, either the company will exist or not, clear, or they are not able to pay their money, clear, or whatever with the financial condition at the end of 10 years, clear. So basically there is a risk arising in the mind of the Rahul, clear. So basically where they will go, here now they will go to the location. Lokesh is basically working as a credit default swap. Clear? Here Lokesh is basically running an agency that is basically working as a credit default swap. Clear? Credit default swap. Clear? What is the meaning of that? Here Rahul is fear that either they will get their money back or not. So basically they will to the credit default swap organization or institution. Basically we can say they are working on that. So what they are saying that basically I have purchased a bond of rupees 20,000. But now I will not know whether I will get my money back after 10 years or not. So basically I want to insure my this bond. Clear? I want to insure my this bond. Clear? I will pay you the premium. Clear? I will pay you the premium and you will insure me that after 10 years. Clear? If the company is not able to pay the money, then you will pay the money. Clear? Then you will pay the money. Clear? So here basically what they will do. Clear? This is the work of that company. Clear? So basically they will take the premium from that. Clear? Basically they will take the premium from that and give assurance. Clear? That they will return the money. Clear? That they will return the money. So here what will happen? Clear? They will take their premium. Like basically we are saying that insurance one in simple language. Clear? So basically after 10 years, if the company not default, clear, if the company not default, clear, so there is not any role of the CDS because they get their money back from the company, clear, from the exposure. And in case the company defaults, clear, and in case the company defaults, so basically they will get their money from the location, clear, they will get their money from the location, clear. So this is simply known as the credit default swap. This is simply known as the credit default swap, clear. So here one thing more, here if the company is not default, clear, so basically why this, how they got benefit, clear, how they got benefit here, because they also know, clear, they also know the rating of the company, clear, they also know the rating of the company, clear. If the rating of the company is good, so basically they know that basically there are very less chances of the default, clear, there are very less chances of the default, clear. Similarly here, if the bond is not defaulted, clear, so basically they will get their money from the company. So here Rahul will pay the already premium. Basically, we can say that basically premium is rupees 1200. Clear? So basically, Rahul will lost rupees 1200. Clear? In case the company is not defaulted. Clear? Default. And in case the company defaults, so basically this 1200 basically helps to the Rahul, clear, to get all the money back. Clear? To get all the money back. Clear? So basically, this is the whole scenario of the credit default swap. Clear? This is the whole process of the credit default swap. So let's discuss it. Basically, what they are saying that this is a bilateral contract, yes, between the two parties in which the risk seller, that is the lending bank, pays a premium to the buyer. Clear? That here risk seller basically we can say lending bank here is to be Rahul, pays a premium to the buyer basically here that is Lokesh, for protection against the credit default or any other specified credit event. Clear? To the buyer basically for protection against the credit default or any other risk basically specified credit event, clear, or any other specified credit event, clear. Normally CDS is a standardized instrument of ISDA, clear, ISDA. I request all of you please remember the full form of the ISDA, that is International Swaps and Derivatives Association, clear. Normally CDS, it is a standardized instrument, clear. it is a standardized instrument of ISDA. ISDA stands for basically International Swaps and Derivatives Association. Clear? International Swaps and Derivatives Association. Clear? So basically, this is the whole discussion of the credit default swap. Clear? This is the whole discussion of the credit default swap. Clear? In this session, basically, we have to discuss up to this much point. In the next session, basically, we have to discuss regarding the credit linked notes. Clear? Credit linked notes. Clear? So there is also some discussion under the CLN, clear, of CDS. Clear? To understand the CLN, basically you have to understand the CDS. Clear? That's why basically in this session, basically we have discussed regarding the CDS. Clear? What is CDS? Hope it is clear to all of you. Clear? In the next session, basically we have discussed regarding the CLN and some of the credit rating agencies. Clear? And some of the credit rating agencies. So thanks to all of you for attending this session.